So today I'm going to go over why do home prices change. If you've ever heard of supply and demand, this goes into that a little bit. First off, we have inflation. So even if there's no change in demand and supply, effectively the prices should go up about, at the moment, about 3 to 4% because that's where our inflation is currently at. Long run, we try to keep that inflation number to about 2%. Homes still outpace inflation a little bit. So let's take, for instance, this red curve. Let's call this the current supply. This is the number of homes for sale at any given price. If people are only willing to pay, say, $100,000 for a home, not too many people will want to sell their home. If people want to pay $500,000 for a home, people will gladly sell their home. So here's a demand curve. It goes down to the right. And what you'll see is that at higher prices, fewer and fewer homes are willing to be purchased. And for lower prices at a given interest rate, effectively more homes would be purchased. So let's take this red curve as pretty close to the current supply curve, and this blue curve as a current demand curve at 7% interest. So with this, if you have higher prices, less people would demand that, therefore less homes would be sold. As the prices go down at any given price, more homes would be demanded effectively. Where you have demand intersecting with supply, that's where you get your current price. So if you come over here, okay, maybe you're at $420,000. Well, what happens if the interest rate keeps going up? Well, basically you go to a lower demand curve, say you're at 10%, for approximately a 1% change in interest rates, people can afford about 10% more, but if interest rates go up, you can afford about 10% less. So that might drop basically the cost by about 30%, and then that would come over here and okay, now they're $300,000 instead of $420,000. So that's where those curves intersect. So how do you fix this problem? Some people will say, well, if you just drop the interest rate, then people could start to afford homes again. Well, the problem with that is if you drop it to 6%, now the prices of homes will basically go up by 10%. So just people that are waiting for interest rates to drop, I think it's going to be very bad. They're not going to expect this, but home values will skyrocket as soon as interest rates would go down. It's not going to necessarily fix the problem. Just like money doesn't solve problems, it's actually the goods and services that are supplied by other people. So we don't need a lower interest rate. What we need is a bigger supply of homes. And you get more supply of homes, either new homes come on the market because they're being built, or you could have a downturn in the economy, such as a recession or something like that, which nobody really wants. Even if more expensive homes come onto the market, any supply is better than not having that additional supply, because think of it this way. If I want to buy that nicer house, well, I'm going to sell my smaller house, and then that opens it up for someone else to move into that house, which then frees up maybe a starter home. And so that's why even building more expensive homes does help with the supply of the housing market. So if we have that increased supply, effectively along any one of these demand curves, what happens is the price of the homes come down. That's basically the interaction of supply and demand. So if you find this interesting and useful, please subscribe. I cover a lot of financial education topics, mostly around how to invest, how to save money, how to save on taxes, and how to make more money. So thank you for watching and have a great day.